everyone, and welcome to the Third Thursday Themes webinar series. I am Matt Lindholm, one of the team members here at CAZ, and I'm joined today by Jan Robard, founder and managing partner at Dawson Partners, which is going to be a new name for many of you, but formerly known as Whitehorse Liquidity Partners. We're going to jump into the discussion today, really excited about that, on private market secondaries, and liquidity solutions for private market secondaries. So Jan, thanks very much for joining us. All right, so let's jump in. If you would, Jan, let's start with an overview of what Dawson is, and you can discuss the name change, and what the investment strategy is, and how would you encapsulate that into a theme that your strategy participates in?
Well, first of all, thanks for having me on. We're excited to have that conversation today. So just the short summary is that Dawson Partners was founded back in 2015. We've been in business for nearly a decade now, and we have raised over $18 billion, deployed over $22 billion. We've grown to 175 people. And essentially, the name change was done so that we could own the name across the world. So what we had found is we had kind of started expanding to London, England last year, that it was getting hard to actually own the name across the world. And so we chose to rebrand to Dawson to enable us to have a name that could future-proof us for the future of our firm. And so if we're going to talk about what we do at Dawson, is that really what we do is we provide structured liquidity solutions to the private equity investors. And essentially what we have is we operate in the ecosystem of the secondaries market. For those that are not familiar with the secondaries market, if you invest in a private equity fund, that is a 10-year partnership in year 3 to 5 if you want to generate liquidity on that private equity partnership. It's not like the public markets. You can't just go and sell that particular interest. So there is a sub-industry called the secondary market, which operates at about $100 to $130 billion a year over the last 3 years, which essentially enables people to generate liquidity on their private equity portfolio, to allow them to tactically reallocate, and particularly in a market where there has been a lot of public market volatility and has created some volatility to allocation models. This is a part of the industry that has seen a lot of growth and a lot of volume. Not just in the last 2 to 3 years, but actually in the last 15 to 20 years. So essentially, if you're looking to generate liquidity on a fund or a portfolio of funds, as an example, generally speaking, you're generating liquidity at about 80 to 90% of net asset value, depending on the quality of the portfolio, depending on where we are in the market cycle. And sometimes it's more and sometimes it's less. And really, Dawson came to be somewhere between the debt and the equity, and provide a third solution to folks looking to generate liquidity on their private equity portfolios, and to provide a structured solution. So in the simplest form, what we do is, at the place of giving you 80 to 90 cents today, what we do is we'll give you 67% of the value of the portfolio. We'll take 100% of the cash flows until we get to minimum returns, and then we'll split cash flows between yourselves and ourselves. And that's the simplest way to describe our strategy. Now, essentially what we are is portfolio financing for private equity portfolios. We essentially generate about, our portfolios give ourselves about 1.5 times asset coverage at closing. But what it really does for investors that use our products is that it enables them to generate liquidity on their private equity portfolio without crystallizing a loss, without losing future upside in the portfolio, given the cash flow sharing mechanism, and without time in the market. And in a world where LPs have become more active and more sophisticated in the way that they manage their private equity portfolio, we have been well received and well adopted by the market. To put some numbers around that, we've seen over $650 billion go through our shop. We've done $22 billion of that. That's about 3% of what we've seen. We are long opportunity and short capital. And really, it's not just us, it's actually the market, to be honest with you. So our theme for today is that the secondary market is vastly undercapitalized. There is a lot of pent-up liquidity needs in private equity for private equity investors. We can get into the details of why that is so. And there's not enough capital to absorb that pent-up liquidity need. And so essentially what we're finding is that liquidity is coming at a premium in this market, and that at the end of the day, it is a buyer's market if you're looking to generate or inject liquidity in otherwise illiquid asset class, particularly over the last 2 or 3 years where distributions have really dried up.
Well, you said a lot of things there that I think will actually lead us right into the next couple of questions. And yeah, and you know us well, and you've heard us say many times in the past that where we are focused first is on downside. What's the worst case scenario? And if we can get comfortable with that, the upside will take care of itself. So when you think about Dawson, the secondaries market, your strategy in particular, how do you quantify the downside and what the worst case scenario is?
Okay, so the ever the optimist, I'm going to answer with some context before I actually answer the question that you have on board. So first of all, in order to understand where we are in the secondary market, we've got to look back to understand where we are. And essentially, there's really two things that LPs or private equity investors are struggling with these days as they look at their private equity portfolio. First is over allocation to private equity, and second is negative cash flows as they've built out their private equity portfolios. And both of those have created a lot of pent-up liquidity needs in the private equity, and that's really being kind of brought to the secondary market. Let's understand why that is. Let's start in 2021 in order to be able to tell the story. In 2021, essentially, we all forget, but 2021 was a great year for the markets and even a better year for private equity. LPs or private equity investors in their private equity portfolios did too well. They were a victim of their own success. And essentially, if you had a 10% allocation to private equity and your unrealized portfolio went up faster than public markets, guess what? You were over allocated to private equity for the right reasons. And then 22 happened. Public markets declined. And that compounded over allocation. And then in 23, distributions dried up and caused negative cash flows for private equity investors. And so what you saw over the last 2 or 3 years is that LPs, private equity investors, have been, really struggling with their allocation models and with liquidity. And that's created a significant amount of demand in terms of the secondary market. Now, the issue is that the secondary market isn't capitalized enough to absorb all of this pent-up liquidity. So let's put some numbers around that. In 21, 22, and 23, 352 billion got deployed in the secondary market, provided liquidity to the private equity investors, but only 210 billion got raised. Okay, say that again. 352 billion deployed, 210 billion raised. That's 60 cents raised for every dollar deployed. And that means that dry powder in the secondary market has been shrinking.
Yep.
Not just over 3 years, but every single year. And so what you have is whenever a market has more demand than capital, it becomes a buyer's market. And that's what has happened over time here in the secondary market. Now, this will resolve itself over time, but it will take time. So let's go to the question that you actually asked. The question that you asked is, what's the potential headwinds around this particular downside? And the downside is, what happens if the secondary market all of a sudden gets very capitalized? And all of a sudden, there's all of this capital that comes into the market, and LPs don't need that liquidity anymore, and private equity distributions have come back. Then you will have an overcapitalized market. But here's the thing. For all of that to happen over the next 6, 9, 12 months is, for us, not impossible, but it's hard to foresee. You would have to say that all of a sudden LPs would start committing to the secondary market very rapidly. And right now it's a difficult fundraising environment despite public markets recovering. You would have to say that pent-up liquidity needs for LPs will have shifted pretty drastically overnight. And actually, 50% of LPs are over allocated to private equity, and there's huge negative cash flows in their private equity portfolio. That means that it will be very hard for that to shift overnight. And 3, distributions in private equity will need to come back fast and furious. And while we see liquidity on the horizon, there is a time period required between when markets open up, which we're feeling that they're doing right now, and the time for assets to come to market, to have the bid process, to have the closing, and the distributions to come back to their LPs. Usually that's 3 to 9 months. So from our perspective, what we see is a secondary market that is long opportunity, short capital, that won't resolve itself overnight. The downside discussion is if that goes a lot quicker than we would expect, which we don't see signs of that yet. And so that means that over the next little while, this will be an attractive market to invest in. What I will say, though, is that despite what I just said, what I wouldn't want is people to walk away and think that the secondary market is a rainy day strategy. It works in good times and bad. Remember in 21 was actually the biggest year for secondary. Why? Because when people got over allocated for the right reason, they still needed to tactically reallocate their portfolios. So secondary market is attractive in all markets. And then the question is how much capitalization in there. And right now there's less than 1 year of dry powder in the secondary market, which compares favorably to the primary market out there.
Yeah, that's really helpful. And I'd love to unpack just a little bit further on specifically the downside. And when you think about what Dawson does specifically within the secondary market, what types of things are you putting in place structurally that help to mitigate against some of those things that you referred to in the event that things do go wrong broadly in the market?
Yeah, so we look to generate resilient returns, consistent cash flows, and muted volatility. We do that through focusing on highly diversified portfolios that enables us to protect ourselves between esoteric events. So we diversify our portfolios by asset, by sector, by geography, by vintage year, by duration. And we're very thoughtful about portfolio curation in order for us to, as much as possible, reduce the range of returns and provide ourselves as much downside protection as possible. The second thing we do is we focus on quality GPs. One of the things that we learned along the way is quality counts. And so what we tend to do is focus on the large, big buyout established managers that themselves have the experience to go through cycles in good times or bad. They know how to manage through periods of volatility like over the last 2 to 3 years. And that's really how we kind of focus it. And then the last part of it is our structure. As we said, we provide 67% of the value. We're taking 100% of the cash flows, which means that we are 1.5 times asset covered by the time that we essentially kind of put our capital to work, which allows us the structural protection to be able to come through for our investors. And in a period of time where we don't know where the world's going to go, where we sit there and say, okay, we certainly don't think we're out of the woods yet. I think there's a lot more clarity in where the world is going, certainly from a year ago, and that's what's enabling the markets to open. But at the same point in time, there's a lot of unknowns out in the marketplace. And there's, higher interest rates for longer. There's going to be geopolitical realities out there that's going to create volatility from time to time. And so to be able to essentially allow a product that provides that resilient returns in good times and bad, we think is interesting.
The next question is really about headwinds, and it's an interesting one for you because Dawson's strategy is not sector focused. It's not healthcare or sports or energy. So when you think about Dawson and the strategy that you employ in the secondaries market, what types of headwinds can actually be material in today's market that would affect the strategy directly, and which of those, if any, give you concern in today's market?
I mean, I hate to say it, but the headwind is that the market is undercapitalized.
Yep.
Private equity investors, at the end of the day, they need to know that they will be able to access those capital pools to inject liquidity in their portfolio. So you need consistent capitalization of the industry, and you need enough to absorb the pent-up liquidity. And so I think that for us, the headwinds is just like making sure that the market as a whole stays capitalized so it can offer that, liquidity solutions to investors when they need it the most.
I think you've talked through some of these already, but which tailwind that exists for you are you most excited about that gives you the confidence that over the next few years you might actually perform above expectations?
And I think it goes back to the pent-up liquidity needs in the markets. Look, the last couple of years have been very tough in terms of distributions. Distributions have dried up. We all know the story. The M&A is down 70% over the last couple of years. IPOs are down 85% over the last couple of years. And so not only are LPs dealing with over-allocation, they're dealing with negative cash flows. Start with over-allocation. I already told you the stat. By the end of 2023, what we saw was reports that showed that 50% of LPs are over-allocated private equity. So despite the public markets having a run in Q4 of 23, the issue is far too broad and far too deep for it to have been resolved that quickly. But the second thing that people are struggling with, certainly in 2023, is negative cash flows, right? And so we kind of dug into this a little bit more. And we said to ourselves, okay, well, how bad has it been over the last couple of years? So we went back to the global financial crisis. And we asked ourselves, okay, in the global financial crisis, what were the liquidity and how does it compare to the last 3 years? And it was shockingly similar. So let's talk about 2007. That was a year of high liquidity, the peak before the crisis. If you had $100 in net asset value in private equity, you got 40% of that back in 2007. It's a huge liquidity year. In 2008, you got 20% of it back as Lehman happened. In 2009, we all know that was the trough of the global financial crisis, 9%. That's how much it went down over 3 years. Guess what? 21, 22, 23, what happened? In 21, 43% of your money back. Huge year for liquidity. In 22, 20% of your money back. And in 23, 11% of your money back. If you look back to it, we essentially recreated the global financial crisis in terms of distributions for private equity investors over the last 3 years. So a lot of people know it's been bad in terms of distributions. That's how bad it's been. There is such significant pent-up liquidity needs in the market. By the way, in 2010, when the markets came back, you got 27% of your money back in that year. It tripled from 2009 to 2010. So let's see what's ahead in this as we come out of this crisis. But there's definitely, GPs have generated very few distributions for their LPs over the last couple of years. And as this market has been opening up, as there's more clarity in terms of, look, last year we were talking about hyperinflation, hard landing. We're talking about where are interest rates going to peak. Yeah, we're not out of the woods today, but we're talking about more like soft landing. We're talking about, okay, the interest rates are going to be longer or higher for longer, but we're treading in the right direction, right? And it was really, the market just needed a little bit more clarity in order for the markets to open up and deals to get done again. Because what you needed was bid-ask spread to narrow in order for fluidity to come back in the market. So we're feeling it now, but it's still, there's a difference between when you start feeling it and when you start acting on it and when you start seeing distributions around.
As you think about what might be the catalyst for really creating the upside case, we know the firm to be really conservative underwriters, and most of your base case modeling is quite conservative on forward-looking assumptions. When you think about the catalysts that exist today, and I think I know the answer to this, but when you look at distribution activity, for example, that came out following the GFC and highlighting the similarities between the last 3 years and what the GFC period looked like, what are the catalysts that could specifically allow us to hit the upside case on some of the investments that you own?
Yeah, look, on average, you get about a quarter, 25% of your capital back in a mature portfolio for private. It has to be a mature portfolio for private equity. So, you know, in a world where in 2023, we got 11% of it back, you got less than half of what you see in the normal average. So over time, as liquidity comes back, you know, it should revert back to the mean. And there should probably be a couple of years of catch up as there's been, you know, a little bit of pent up liquidity needs. But here's the thing. I'm going to fast forward more than just this discussion around what's going to happen in the short term. And we're on record for saying that we think that the secondary market is going to go $1 trillion by 2031 annually. So people will be like, whoa, wait a second, talking about $1 trillion. To put this in perspective, in 2021, $132 billion traded in the secondary market. So you essentially need to see this thing sevenfold over the last decade. Guess what? It has done that over the 2 prior decades. And if we kind of think about what's going to drive this market to $1 trillion, let's look first at private capital. Private capital grew from $5 trillion in 2016 to $15 trillion by 2021. Can it actually, by 2023, so 15 trillion by 2023. Can it go from 15 trillion in 2023 to 30 trillion 2031? Going from tripling in the last 7 years to doubling in the next 7 years. What's going to feed that? Private wealth. A lot of private wealth investors are looking to get into private capital. That should be, you know, maybe even a bigger number by the end of 2031. If we convinced you that the private capital market can grow to 30 trillion by 2031, all you need is just over 3% of that market to trade in any single year for us to get to $1 trillion secondary market. Just going to say that. Even in our largest year at $132 billion in 2021, we were 1% of private capital that traded. 1%. Okay. So if we get to 3%, how do we get to 3%? LPs are going to be a lot more sophisticated in how they actively manage their portfolios. GPs are going to continue to use this thing called continuation vehicle, which is their fourth exit way to actually generate liquidity for the LPs. That's a whole discussion in itself, and we could go on for a half an hour around that. And three, the maturation around private credit, infrastructure, and real estate. All of that can drive very quickly towards $1 trillion market. And by the way, in 2011, the market was 25 billion. It got to 132 billion by 2021. Can it get to 1 trillion? Time will tell. We think so.
So when we put all those puzzle pieces together and we encapsulate the tailwinds and the headwinds and the risks and the rewards and the upside case, if you had to place a score from 1 to 7 on the current risk reward in investing in your space, with 1 being the absolute worst risk reward in your career and 7 being the best possible time to deploy capital, where are we today?
Well, I would say 7, but I think people wouldn't believe me. So I'm going to go 6.
Okay.
And it goes back to what we just talked about. Like it's been 2 dire years of distribution, and LPs are significantly over allocated, and there's negative cash flows in their portfolio. And so not just for our strategy, for secondaries in general, I would say that this is an interesting time because there's just so much pent up liquidity and there's not enough capital to absorb it. I'm going to say those numbers again. 352 billion got deployed in 21, 22, 23. 210 billion got raised. 60 cents raised for every dollar deployed. This is a market for over the last 3 years have been shrinking dry powder, not growing it. In a world where pent up liquidity has been growing, not shrinking.
I mean, I agree. I think it really is just a super compelling case right now. And so related to that, and one final question for you is, when you think about the secondary market, liquidity solutions for GPs and LPs, you think about today's environment, what is it, if anything, that you think investors really misunderstand in this market?
Our mantra at Dawson is scale matters. We've said for the last few years that big is beautiful, growth is good. And that sometimes can be uncomfortable hearing that as an investor. But I will tell you that scale, we believe, has enabled us, not disrupted us. We think that we have gotten bigger, better, faster, stronger because of the growth that we've been able to grow here. It has allowed us to be more resourced, more informed, more sophisticated than we've ever been before. At 175 people, it takes a lot of effort, hard work to know these are massively diversified portfolios, and you need to get under the hood to understand what it is that you're generating liquidity on. We are tech enabled. We're very proud of the internal technology platform that we built to enable us to be able to be highly sophisticated in how we underwrite our portfolio so that we know what we're generating liquidity on, so that we be able to position ourselves to underpromise and overdeliver. But the scale matters is something that's underappreciated. I think people sometimes equate big with a different mantra. We believe big is beautiful, growth is good, scale matters, and scale has enabled us.
Thank you so much for that, Yan. Really, really appreciate you taking the time to join us out of your busy schedule, my friend, and further the education for our ecosystem on private markets, secondaries, liquidity, et cetera. So thank you again, everyone. Please have a fantastic day.
You guys have been great partners. We appreciate you so much.